The functioning of the homeowners insurance market is a critical step towards coping with climate change.
It should ultimately lower premiums and make them more predictable and stable over time for homeowners.
You can explore the report and the path to more affordable coverage at brookings.edu. If you want proof that climate change is already impacting the economy, look no further than the home insurance market.
Insurance premiums for homeowners have gone up around 25% since 2020.
If you want to take on a mortgage, you have to have an insurance policy, and most people can't buy a house without a mortgage. And so that chain is disconnected when potential home buyers or homeowners can't find affordable home insurance.
Rising insurance premiums are a symptom of a larger problem.
We are seeing more frequent and severe disasters, but premiums are also being driven up by the ways in which insurers protect their downside risk through reinsurance.
Reinsurance is insurance for insurance companies.
These are large insurers that operate on a global scale, and they tend to be in a better position to hold severe hurricane and wildfire risk than a local company.
Insurers have to protect their downside just like homeowners have to protect theirs, and they do so through reinsurance markets.
As climate disasters grow more frequent, global reinsurers must hold massive amounts of capital in reserve, and maintaining that level of liquidity is incredibly expensive.
Reinsurance rates have skyrocketed over the last 10 years or so, essentially doubling in cost, those costs that are being passed on to homeowners.
To restore stability and lower costs, Ben Keyes, Ben Collier, and their colleague Phil Mulder propose a new federal entity to manage the extreme risks currently driving private companies away.
We propose U.S. Re, a government reinsurance entity that would help lower the cost for insurance companies to manage the really severe catastrophes.
U.S. Re would help reduce some of the uncertainty and the volatility in the cost of capital, and ultimately provide more stable, continuous insurance coverage for U.S. homeowners.
The scale of these catastrophes is so great that they exceed the capacity of the reinsurance industry. The U.S. government is in a better position to hold those catastrophe risks, and they tend to be in a better position to pay large amounts of funds in a short amount of time.
So we don't see U.S. Re as a bailout for the insurance.
Morning, everyone. I think we're going to go ahead and get started. Good morning, and thank you for taking the time to join us today. I'm Aviva Arendine. I'm the director of the Hamilton Project at the Brookings Institution. And on behalf of the Hamilton Project and our partners at the Hutchins Center on Fiscal and Monetary Policy, I'm very pleased to welcome you to today's conversation on homeowners insurance and growing climate risk. The U.S. homeowners insurance market is facing mounting strain from severe climate risk, and so today's discussion will focus both on the dimensions of the problem and how policymakers can respond. In conjunction with today's event, the Hamilton Project is releasing a policy proposal from Ben Collier, Ben Keyes, and Philip Mulder for a federal reinsurance entity. You'll hear more about that proposal shortly in the first of two panel discussions with leading climate and insurance experts. But first, we're very honored to welcome Minnesota Commerce Commissioner Grace Arnold and Colorado Insurance Commissioner Michael Conway for a fireside chat with David Wessel, who is the director of the Hutchins Center. We'll have time for Q&A as part of each of the sessions today. For those who are joining online, you can ask questions by following us at HamiltonProj and using the hashtag #ClimateInsurance, or by sending an email to info@hamiltonproject.org. And David, I'll now turn things over to you.
Thank you all for coming, and good morning to people who are in the room and online. We're very pleased to have two people on the front lines of this problem, people who are commissioners of insurance. Grace Arnold is the commissioner of the Minnesota Department of Commerce, which insurance isn't enough for her, so she does a lot of other things. She told me she delegates a lot, which sounds like a good idea. She joined the department in 2019 and has been head of it since 2021. Earlier in her career, she spent nearly a decade at the Center for Medicare and Medicaid Services. Michael Conway is the insurance commissioner in Colorado. He joined the department in 2016 and has been commissioner since 2019. Before that, he was in the state attorney general's office where he represented the insurance department. Both of these commissioners are appointed by the governor, not elected as they are in some states. Both of them are states where property and casualty insurers can file rates and use them subject to the review of the commissioner after the fact. Both states have fair plans, residual plans for people who get insurance anywhere. Minnesota's had one for a long time, since the late 60s. Colorado's only since 2025. And just to set the stage a little bit, according to the data that Ben Keyes and Phil Mulder have gleaned from looking at mortgage escrow payments to try and figure out how much people are paying for insurance, in Colorado, the average premium is $4,142. It's risen 76% between 2020 and 2024. That's a period of time where the Consumer Price Index rose 21%. And the major perils in Colorado are hail and wildfires. In Minnesota, the average premium is $3,286. That's up 60% between 2020 and 2024. They also have a major peril of hail, but also some problems with snow and ice, if I read the website right. So I wanted to start with each of you. Maybe I'll start with you, Commissioner Arnold. What premiums are going up in your state? I'm sure that both homeowners and legislators have noticed that. So to what extent is this, what's driving this? To what extent is it the frequency and severity of storms? What extent is it other things like reinsurance premiums or litigation or construction costs? What are the major drivers?
Yeah, so you mentioned a few of the big drivers. We don't have good breakdowns of it's this percent of the increase, it's this percent is attributable to this. I think we're working on some data that will hopefully be maybe not able to answer that exact question, but at least directional. So we see increased construction costs, so that's inflation. Most of our claims are things like big storms, so severe convective storms or derechos, which are a newer phenomenon, but they are super powerful. So we've had a number of those come through. Things like tariffs end up in premiums. We hear sometimes about litigation costs. I don't have good data to say that that's actually a problem in Minnesota, but I'll just, for transparency, we hear that that's a problem sometimes. And then the overall cost of reinsurance. I think it's also worth it to note that as premiums are going up, coverage is going down quite a lot. And so consumers are ending up on net at more financial risk than just the premiums
Coverage is going
indicate.
because they're taking higher deductibles or lower caps?
In our case, yeah, mostly it's roof coverage changes. So there'll be like a fully separate coverage for your roof. You'll have a separate deductible. It'll be a cash replacement value for it's a depreciated value. So if your roof is 10 years old, then you'll have little to no coverage compared with a newer roof.
And how much pressure is there from the legislature to do something?
We have a homeowners task force. I think the other thing that's I've learned is somewhat unique about Minnesota is a lot of our homeowners are part of homeowners associations. So in the Twin Cities metro area, which is where most of our population is, something like 20 or 30% of homeowners are in homeowners associations. And so the way that a consumer feels that price pressure is totally different than the way I feel mine in my 1945 home in South Minneapolis, which is just a standalone home purchase.
I mean, because it comes through your HOA fee.
Yep, it's the HOA fee, and then it interacts with your own personal insurance, and so it ends up as more of an HOA conversation than it does an actual individual premium conversation, and so that's actually the way that it's come up in the political space in Minnesota.
So could you ask the people outside to fix the clock, which isn't working up there? Thanks. So Commissioner Conway, how about in your state? What's driving premiums up and what's not?
First, thank you to Brookings for having us. So for us, it's hail. It's not, so on the litigation risk side of things, so I've been kicking around this job for almost 9 years at this point. From the very get-go, we've been asking the industry for data about litigation risk and the impact of litigation risk on premiums, both on the personal auto side, but on the homeowner side too, because it's a talking point, right? It's been a talking point out there forever. And I've been very clear with the trades, with everybody, that if you bring us data, I know we're a blue state, but if you bring us data, we're not afraid to take on fights, and we'll go after that litigation risk. But on the back end, you're going to have to guarantee that any savings that we actually achieve through any kind of tort reform, you've got to pass that through. And whenever I say that part to the industry, they roll their eyes and then they walk away from the conversation. So I think maybe that's why the data hasn't come our way, but we've been very clear that we're willing to have the conversation and the data just hasn't come. So I tend to question that a little bit, that talking point, maybe more than a little bit, maybe quite a bit. But for us, the real driver of premium is hail risk. The construction aspect of things, right, those increased costs we're seeing show up in premiums as well. But it's hail, at the end of the day, taking out roofs in Colorado, taking out a lot of roofs on a regular basis that drives up our premiums. We actually did a data call earlier, well, I guess late last year at this point, really to look at what the portion of premium that people are paying is attributable to hail versus the portion that's attributable to wildfire. Because constantly, right, what you hear about, at least out west, is that wildfire is the thing that is driving up homeowners insurance premiums. It's the thing that is driving up all of the challenges that we have in the West. And that's simply not the case for us. What we found was that on average, in our kind of front range counties, which is the Denver metro area for all intents and purposes, about 50% of the premium that people are paying is attributable to hail. On the low end, the portion of premium that's attributable to wildfire for those counties was around 4 or 5%. Go into the mountains, where hail doesn't really hit. I mean, it hits to some degree, but it's not taking out roofs any place close to the same percentage as it does along the front range. And even in those counties, so the Summit County, which is, for those of you that know Colorado, if you've gone skiing there, that's where Breckenridge is. In that county, which has a lot of trees and a lot of trees that could burn, the portion of the premium that's attributable to hail is just north of 30%. On wildfire, it was closer to 7%. So wildfire, it is a problem for us in certain pockets of the state, but it's a problem really more on the availability side. It's hail that is driving our affordability challenges really everywhere. So that's where we're focusing our work going forward, is really on the hail side and trying to help people fortify roofs, and then we're going to have some conversations about how we can build some reinsurance relief, what we're calling reinsurance, and it's really not truly reinsurance, but what we want to build a reinsurance program for those pockets of the state where we do have wildfire, both affordability and availability issues, to take on some of the risk from the market to encourage the carriers to go back into those places and increase competition. But at the end of the day, from a macro level standpoint, it's all about hail in Colorado.
What is, you're calling it reinsurance, but it's not reinsurance. What are you talking about?
So we're calling it reinsurance because it's an easy term that people think that they understand when they don't actually understand it, especially politicians. So it's something easy that the legislature can latch onto, and they think they understand it because we have a health reinsurance program. So they're versed in that, and it's easy for them to really kind of grasp it. What we're really talking about for us in Colorado, right? We're not talking about supplanting or supplementing the traditional reinsurance market. Right? The traditional reinsurance market, for most of you in this room, you know what we're talking about, but some of you are directly in this space. Right, for our homeowners insurance companies, their attachment points, they're all at $1 billion or north of losses for all of our big insurance companies in Colorado. Our wildfire events, right, the places that I talked about where we have issues with availability and affordability from wildfire specifically, we don't have enough risk in those areas for any one insurer to get any place close to their attachment point with their reinsurance programs, with their reinsurance treaties. So we need some sort of kind of middle layer of relief that we're able to provide, whether that is through some sort of reinsurance mechanism that is kind of more like along the lines of what a traditional reinsurance would provide, or it's something else, right? And there's going to be some folks that are going to be up here in a minute talking about the different types of reinsurance programs that have been kind of put forth in markets around the world. We're talking about building, like I said, some sort of middle layer relief that isn't there now, right? That the market isn't providing, so we wouldn't be competing with the reinsurance market. I think there's some folks from RAA that might be here that get very nervous whenever I start talking about this. But we fundamentally know that if we don't start to address the issues that we have from the kind of in those pockets of the state from an affordability and very specifically an availability solution, we're going to have a growing problem in Colorado along the Front Range in particular, where we're starting to see more beetle kill, where we're going to have just a number of folks that will have one of two choices. They're going to either have to go uninsured, or they're going to have to go into our FAIR plan if we don't find some other solution to increase competition throughout the state. So we're trying to get ahead of that problem. So I don't know, David, to actually answer your question directly of what this thing would fundamentally look like. We're trying to build, like I said, relief for that middle market and that middle piece of where we need that relief.
So, Commissioner Arnold, how big a problem is availability in Minnesota?
We don't have the availability problems that are, I think, often associated with wildfire. So what we have is decreased coverage. We've had some carriers that have kind of retrenched their books, and so they may have. It's generally been like really small numbers of policies, and it's just not worth it to write in the area. But affordability can lead to availability problems, but we don't have the same. The same sort of circumstances that you see in other states where whole carriers are threatening to pull out, and big carriers with like market share. And so that for me is less of a worry. What I do worry about is affordability. And so we focused a lot on resilience and thinking about, because hail and roofs are like the thing that are the big deal for us as well. And so how can we be thinking about building fortified roof programs? I think we'll hear about this, so I don't want to spoil the conversation later. But trying to think about how you're reducing the claims in general so that you have stronger roofs and you have structures that are more able to withstand
Let's talk
that.
about so for people who don't know, fortified roofs is a standard set by the IBHS that in some states, particularly in the Southeast, the states have now grants to people to retrofit their roofs to this new standard. And I think the logic is that even if you get a discount from your insurance company, it's not going to be big enough to cover the cost. So both your states have talked about this. As I understand it, Colorado has proposed one, it hasn't been enacted. Minnesota has one, but the legislature hasn't seen the wisdom to put any money into it.
Yeah.
So what is it just a funding issue? Why is this such a hard thing?
Yeah, so we've worked for a while to kind of establish the groundwork of the program. We do have a mandated insurance discount, which came with some actuarial work, so that's been sort of the first
But how
part
big
of
is
the
that?
project. It can be ours. I saved $900 a year on mine, so it was. I mean, for the.
You have a fortified roof.
I don't have a fortified. I have like a 40-year shingles, and so the marginal cost of my shingles were like $3,500. Get a $900 discount, so that'll pay for itself in a few years. So that for us was like totally worth it. Prompted a number of interesting conversations about what I do with my husband as we were going through the process. But
He didn't delegate to you this decision?
I delegated it all to him. I didn't want to deal with it. Well, I did see a guy up on our roof, and I was like, "What's going on?" He's like, "Oh, somebody just showed up to see if we have any hail damage." And I was like, "Oh, that's a storm chaser. I don't think we want to be doing that." So, so these are the things that happen when you live in the Midwest and a storm comes through. So those are the kind. So we haven't had the legislature. I think we've had a lot of priorities. I think one thing that's unique about the Minnesota legislature is our budget and policy go together. So we don't have a separate budget track. Yeah. So we don't have a separate budget track. So often when we're doing kind of end of session negotiations, we're trading off budget and policy priorities like together instead of having a budget conversation separate from a policy conversation. And we've just not always had a ton of money to allocated to our area. I think, as we've gotten tighter on budget, I think we'll start to think about more creative ways, and maybe we ask the insurance industry to chip in, but that'll be a next year thing.
And so if you had to pick one or two things that the state could do to reduce the cost of the amount of damage and the cost of insurance, would this be on top of your list?
Absolutely. Yep. I think between that and then we have a lot of work in our climate subcabinet because we have a whole bunch of agencies that are together that are about climate resilience more generally. I think thinking about not just the way that the insurance sector is funding some of the risk, but like we have before us, our largest utility has a request to put a whole bunch of money on ratepayers, so on your electric bills, to do wildfire preparedness. And that has insurance implications because but it also is a cost that's showing up in a totally different sector. And I think the more we can get smart about costs kind of across the board and the way that sectors are subsidizing or bearing different costs, I think that will help design smarter ways to be resilient and to be mindful about the way state dollars are spent, because they're finite. You can't just spend money forever, and making sure that communities are able to invest in the thing that's kind of right for them, I think is really important.
So, Commissioner Conway, you've had a lot of legislative activity in this space in Colorado, and one particularly interesting, at least to me, was a requirement that not only that insurance companies give discounts to people who have done things to make their houses more resilient, but that they take into account community-level mitigation activities. Can you talk a little bit about what does that mean? Why'd you do it? How does it work?
Yeah, so the why we did it part, I think, is an important part of the conversation. So we really started on kind of the homeowners path back in 2020. So I had a conversation, one of my annual check-ins with the governor, and he asked what's going to be the biggest challenge that we've got in the insurance space next year. And I said, well, Governor, the biggest challenge that you're going to have for the rest of your time as governor in the insurance space is going to be the homeowners market. And he was flabbergasted, right? He was convinced that I was going to answer that it was going to be health insurance issues. At that point, the health insurance market was relatively stable. It's not anymore. But right, and the reason why we were so focused on the homeowners insurance market was because, one, we thought we were going to have an availability issue start to creep up on us, or at least the potential for one. So that's why we passed the FAIR Plan and got the FAIR Plan up and running. But we were also hearing the step two in the conversation was to try and address the challenges that we were seeing with the models that were in our space. In particular, the wildfire models and the impact that they were having really in a variety of different ways. But the most frustrating piece of it was when we would go out to consumers and we would have conversations with consumers about kind of what they were experiencing with their homeowners insurance company. What we were continuously hearing was that they were getting a wildfire score from their homeowners insurance company. They were convinced that wildfire score was driving up their premiums, because it was. They were willing to take mitigation steps. They had sometimes taken mitigation steps, but then they weren't seeing that transfer in any way, or in any way that they could understand at least, into kind of decreasing their homeowners insurance premiums. And what we were running into time after time was that the insurance company and the modeling company that they were using would quite often point at each other and say that it was the other's problem to deal with whatever it was that the consumer was challenged with at that point. And candidly, it got to the point that it pissed me off, right? Because at the end of the day, what it fundamentally felt like was that we were lying to our homeowners, and not just us, the industry at large, right? And what I mean by that was we've been telling folks for decades that mitigation is the key, right? That mitigation is the key, not just to affordability, but availability too. And in parts of our state, that's incredibly important. But if the insurance companies were responding to these folks that were actually doing mitigation and telling them that we couldn't really actually answer the questions that they had, it fundamentally, like I said, felt like we were lying. So we went to the legislature and we passed a piece of legislation that really does kind of what David was talking about. We talked about it as a baseline transparency measure. Because from my vantage point, you've got three choices when you're talking about models. And the models in the homeowners insurance space, these third-party modeling companies, they really are making almost all of the decisions, at least in Colorado. I can only speak to Colorado, from an underwriting and pricing perspective. So you've got three choices from my vantage point. You either can create your own model. That's really expensive. Create your own model and make the insurance companies use it. It's really expensive, and then you're the bad guy every time something bad happens because that model tells the insurance company that they should price something differently. So I
want to make sure the insurance company is the bad guy, not the regulators, right?
I don't want to be the bad guy. No chance in hell I want to be the bad guy. Option two is to ban models, right? And that's not a good choice either for, I think, very obvious reasons, right? These models are going to be our future. So that goes into where what we settled on was option three of we've got to improve the models, right? We have to improve the models at least to the point where the insurance company and the modeling company are getting good, usable information, and we're making sure that the mitigation work that people are doing, both at the individual property level, but then at the community level too, because we've got counties around the state that are investing a ton of money in mitigation. So we have to figure out a way so that people can get the return on investment from that. So that's what the bill fundamentally is, right? We put requirements in place that if you're going to use a model in Colorado for underwriting and for pricing, You have to ensure that that model is capturing the mitigation work that the individual property owner is doing, and then at the community level too. The individual property owner, it's relatively, I think, straightforward, right? We've got the IBHS standard, the legislation speaks to the IBHS standard. The community level, I think, is going to take us some work. We also talk about the IBHS standard on the community level, but I think longer term, medium term to longer term, we're going to have to figure out what exactly community mitigation means, because Grace is right? Grace talked about the utilities in her state that are spending hundreds of millions, if not billions of dollars on wildfire mitigation. The same thing is happening in Colorado, right? We have to figure out how we capture that in the models. And I think as importantly, maybe even more importantly, we've got, and I talk with the modeling companies about this all the time, we've got to get to the point where the modeling companies have the ability to help inform the work that people want to do, right? The modeling companies can help us figure out what the future looks like to help build as much mitigation in the right places at the right time to deal with the wildfire risk. I do think the models are the future. I think the models can help us in massive ways, but we have to have a more comprehensive viewpoint than we do right now today.
So, Commissioner Arnold, it seems to me there's a problem here in explaining to people what's going on. So we can do mitigation, and that will help probably reduce the rate at which premiums go up. But we do have more risks. There are more things. So, and we don't, well, maybe we don't, but I don't want to have a situation where we are giving people incentives to build houses in stupid places. I mean, you don't have a lot of Atlantic coast in Minnesota, but we see people.
We're a climate refuge state.
Right, yeah. I mean, I've been to Miami and looked, and I wonder, like, who is building this condo that's as far from the ocean edge as I am from the edge of the stage? So how do you deal with this tension between, we want people to understand the risks they're taking, we also want them to have incentives to mitigate the risks? Is this an impossible balance, or how do you deal with it?
I think a lot of it is just people for a long time, and the industry as well, like, it was sort of set it and forget it. You just, you pay your premiums, and like maybe you talk to your, your agent once a year, and then you just don't really think about it. I think when we started this set of conversations, we had a group of carriers and brokers, and their response was, well, we can either reduce coverage or increase costs, and those are the only two options we have. And I was like, oh, that feels pretty reductionist. And so as I think, pocketbook really drives people. So you see your premium go up a bunch, and people are starting to have different conversations. I did a media interview, so I've done a media interview with the same reporter a couple times. 2 years ago, she was sort of like, it was like clear that it was a quick story for them. They were just talking about increased premiums. This year, she had talked to their newsroom, and every single person in the newsroom had a story. So somebody had bought a new house and couldn't get coverage until they replaced the roof. And so I think that like the dollars and cents kinds of things that just drive people to have conversations that they wouldn't otherwise is really helpful. And then you get it's small, but having a reporter go through the newsroom and say everybody has a story kind of elevates it, and then they're, and then they can figure out how to talk about it, and they do, in this case, do a good job of sort of balancing that there are industry needs and then there are consumer challenges. So I think that is helpful. I think getting the contractor workforce, particularly, I'm thinking mostly about roofs here, so to understand like what the options are and really think of a conversation that's like a value proposition conversation rather than just like, well, you can put this on. And to be able, and frankly, insurers should be doing that when they have claims too, is to say, look, if you do this, it's a little bit more investment now, but you get a discount on your premium, and you're more likely to not have claims in the future because nobody wants to deal with an insurance claim. And so I think that those are the kinds of things that are going to naturally, it's like our homeowners, right? Our homeowners associations. All of a sudden, they all got increased premiums, and now we have a task force, and now we have a bunch of conversation at our legislature in a way that we knew it was going to happen, but just saying, well, your premiums are going up is not all that tangible until they really go up, or you try to file a claim and have a challenge with it.
I think you discovered one of the dark secrets of journalism, which is something is really a problem when it starts to affect people like us, people in the newsroom. Then you know it's a problem. Commissioner Conway, what about building codes? So you don't have a statewide building code in Colorado. A number of states don't have them. Is there a role for better building codes here?
I want to answer your last question.
Okay,
Yeah.
you can answer both questions.
I will. So I think the argument, and I feel fairly passionately about this, I think the argument that that we're going to somehow incentivize people to build in the wrong place if we try and build affordability programs is nonsense. It's at best an argument that is 20 or 30 years past its due date, because this problem has come to the people that live in the areas that are being impacted right now. And fundamentally, I don't understand the argument in Colorado, right? So we're going to build more houses in Colorado. You have two choices in Colorado. You either build houses where hail hits, which is along the Front Range and then into the Eastern Plains, which is, like we talked about before, our biggest peril, or you build houses up in the wildfire country. We're going to build houses along the Front Range. We're going to build houses where hail hits, because that's where people want to live, right? And that's where Denver, Boulder, Colorado Springs are. So like I said, it's a nonsensical argument that is so far outdated, and it ignores the reality of the issues that people are facing on the ground today. David, you talked about it at the front end, right? In Colorado, we've seen over the last 5 years insurance premiums on homeowners alone increase by 60 to 70% on average across the state. Right? We are way past the point of having to worry about building homes in the wrong place when people can't afford their homeowners insurance coverage. And the reality of what that means, right, is that if we don't find solutions for this problem, people will start dropping their insurance coverage or decreasing it dramatically, like Commissioner Arnold was talking about. And that will have other huge downstream impacts. Right? There is a very real world that if we don't start to address these affordability challenges, that we start to have problems in our real estate markets and pockets of Colorado at the very least. So again, that's why I feel pretty passionately about this. The building code aspects. Building code absolutely is part of the equation, right? We have a wildland urban interface building code that was just effectively passed and put into place by our WUI board that the counties are struggling with now of trying to get implemented. But it's not just, right, it's not just about having a code, right? It's as much about having a code, or as much about enforcing the code as having the code. Right. You can pass a code, but if you don't have somebody out there that's actually enforcing it in a meaningful way, it's only as good as the paper that it's written on, which isn't a whole lot. So in Colorado, we really do need counties to step up, and that's a tough thing to do, right? These counties, they're elected officials, right? I'm not an elected official, so I get to just get up on stage and blabber about a bunch of stuff, and people have to listen. I don't have to get elected. But these county officials, they do, right? And they worry about those components. So the enforcement is key, but it's a sticky wicket.
What about, you have a state building code,
Yep.
but IBHS says it's not well enforced. So
Yeah, I think it's differentially enforced for sure.
differentially enforced, I like that.
And I think that what if you're, to the point about county officials, I think this is probably like something to be mindful of, is like anything we talk about here, we can talk about in like very high level. At the end of the day, like humans have to do all the stuff, and often it's a human who doesn't care about anything we're talking about today. And so I think like as we're thinking about policy, like remembering that it's like the construction worker or like the guy who has to like go out and look at the building codes and have a building trade who's like, well, we need more affordable homes. This is one of the big
Right.
storm that just hit in one of the poorest areas of the state. They enforce their building codes, and people are super pissed because they can't afford homes. They're saying, this is the reason we can't afford homes. And their choice is, well, we'd rather kind of deal with it on the back end, but have people actually in a housed structure, because that's more important today than it is in the possibility of having a storm 10 years from now, or 5 years from now, or yearly, which is like more what's happening. And so I think it's definitely a tension. So we were up in Bemidji, which is in the northern part of the state. It's one of the poorer areas. The city enforces the codes, but the county doesn't. And so they had all these like kind of weird things where they would enforce the codes. They had like their building inspector talking to insurance companies because the insurance companies were approving part of the roof for repair, but not the entire thing. But the way the code works, it has to be like what the shingle manufacturer will warranty, which is not replacing individual like pieces. They have to do like big sheets of the roof. And so that was ultimately what helped people get claims. But so, maybe the people in Bemidji are seeing the value of their codes, but I think generally speaking, they
Right.
may not. And I think that's, you know, it's a tough, like we hear about housing affordability all the time. It's a public policy question, and you have to make sure, I think this is to my point earlier, you have to make sure that different areas are talking to each other. So if you really are trying to drive more affordable housing, it's like, yes, and what are the costs in the long run, and are we accounting for those, even if it's not in the housing sector?
I'm going to turn to questions from the audience. We have some people with mics. I'm going to take 2 or 3 questions and then let the commissioners answer the ones they want to answer. It would be better if you ask a question rather than give a speech, so we'd appreciate that, and tell us who you are. And if there aren't, let's start here with, introduce yourself.
Sure. Hi there, I'm Philip Mulder. My question is, I've heard several cases of the state kind of having to mandate these discounts for different adaptation measures. If I were an insurer and I knew that my competitors weren't pricing in these discounts, I would see that as a chance to gain market share, get a better pool of risks. Why do you think the insurers on their own initiative aren't taking those opportunities?
Thanks. Let me take another. You can tell he's an economist. You can tell from that question. In the back.
Yeah, and James McIntyre from the Resiliency Company. One question is on really if there is an enforcement, for example, on the county level versus the city level on code. Or as you're seeing in Colorado, are you seeing technical examples of like defaults on mortgage-backed security markets because people aren't carrying the right insurance on the underlying mortgage? Or are you seeing people like have buildings that effectively, if they were really looked at by the investment community, they would find real problems with the underlying security?
Thanks. All right. Why don't the insurance companies give discounts on their own if it's such a good idea?
Yeah, so you want to take it first?
You go ahead.
Okay. Because they're insurance companies. Come
on.
So in the bill that we talked about that we passed last session, we had an active conversation about whether we should require mandate discounts or we should let the markets do what the market always says that it will do, as they'll compete against each other, and they'll do exactly what you're talking about, right? That they'll provide discounts and they'll gain market share by providing discounts for the mitigation work that people are going to be doing and are already doing. But I was also very clear that as we had those conversations when I was up testifying on the bill at the legislature, that if the industry didn't do what they said that they would do, right, that the market forces would compete against each other and they would do exactly kind of what you're asking, that the legislature will come back and they'll follow suit of what has happened in California and some other states where they do have the mandated discounts in play. I think that's on the wildfire side. On the hail side, we do actually have a pretty active market, to Commissioner Arnold's point from her own personal experience. There is, I think, real competition happening in the hail space for mitigation discounts, for hail fortified discounts, but it just isn't really kind of showing up in the same way in the wildfire space, at least not yet. And we'll see if that starts to change to some degree. When the insurers, when you talk to them, they'll tell you that part of their answer always is that there's not enough data for the models to really capture the mitigate, and that really, honestly, it pisses me off. Because these models are supposed to be the greatest thing since sliced bread. So the model should be able to figure out what the discount fundamentally should be. But that conversation usually stops after I say that.
And I'll just add on, so we looked at the Alabama example. So Alabama started by not having mandated discounts, and then they moved to mandated discounts because they didn't see uptake the way that they had expected. And so that was sort of we just didn't even try to do a market-based thing because we looked at the rest of the country and said, well, we're going to end up here anyway. We might as well start here. But one of the things that was the advantage is that then we were able to work with the carriers and get around some of this like aggregated risk or like we don't have enough data, because then we assigned the discount but working with carriers. And so we like sort of had a standard that we worked with them on. And that kind of like took away that ability to have that talking point and gave us, I think, probably better information about it. And that's specific to a fortified standard. But I think that like allowed for a different set of conversations if we had been having the conversation in the context of either a market-driven response. Then I think we would have not had enough information to be able to say like what the actual value is, which is valuable for us as policymakers because we know the difference then.
So I think McIntosh's question was, a lot of mortgages are securitized. Yeah. Investors are holding these mortgages. Do they put any pressure on the system to make sure the homes are resilient? just one fact, Kevin Stiro, who did a lot of work at the Federal Reserve Board on this, when they stress tested the banks on climate, they found that banks had surprisingly little information about what the insurance was on the individual properties on the mortgages that they had on their books. But do either of you have any insight into the Macintosh question?
I mean, effectively, right, what you're talking about is an underinsurance problem, and the magnitude of that underinsurance problem. So there is a big underinsurance problem. Is it big enough to really actually threaten the underlying security? No, I don't think so. At least based on our experience, right? When the Marshall Fire happened a handful of years ago, we lost about 1,100 homes just north of Denver. And we had a big underinsurance problem, someplace in the tune of 30 to 40% underinsurance problem, but that wasn't big enough to threaten the underlying mortgage itself because there was enough coverage there.
Right.
I think if it gets bigger, right, as Commissioner Arnold was touching on earlier, the affordability challenges are leading to people decreasing their coverages in a variety of different ways. Typically, that's showing up right now, at least in Colorado, in deductibles, and we're not seeing them take big buy downs on their coverage A. But if you start to see big buy downs on coverage A, it starts to be a different conversation. The commercial market is, I think, a little bit more of an unknown, mostly because that's all going through the surplus lines market, at least in Colorado. The majority of it's going through the surplus lines market, and we just don't have as much insight there. But I don't know that that's really the underlying risk that you're talking about with those types of securities either.
So, woman over here.
And while there, I'll just
And
add
man
on
over here.
that we hear a little bit from our bankers of when there are increased, because we oversee banks in my department as well, banks and credit unions. So we have heard a little bit about increasing insurance pressures. I think the translation of that then back into the resiliency of a particular structure is not translating as well, although we have had some conversations in a few institutions that I think are savvy to the fact that there's a financing problem too. And so if they, were a little bit more creative about the way they marketed like their home equity lines of credit, then people might, put on a new roof that then lowers premiums and then gets the benefits of both resiliency and insurance. But that like second step is like, I can see the seeds of it, but nothing's growing yet.
Hi, everyone. My name is Sylvia Alston. I own an insurance brokerage in New York and New Jersey. One of the issues that I think that and you've talked about it a little bit, but there's other pieces to it. In the high net worth space, we are able to do replacement cost on the dwellings. On the other structures and contents coverage, we can help insureds buy back premium by reducing those limits. But on Main Street policies, for most of our other clientele, you have to take what the carrier gives, right? So it's 70% typically of the contents coverage goes along for the dwelling, and all of the other features are built into the policy. There is no ability to reduce the coverage. You have to take what the carrier offers. Another point that I wanted to make is that in New Jersey and New York, most insurers will not even take a home. They won't consider it because of older infrastructure. They won't even take a home with the roof 20 years or older. And most of the companies that are building or putting asphalt shingle or composition shingle on the roofs are guaranteeing that the roofs are good for 40 years. So there's a complete disconnect between the builder, the insurance carriers, the clients who are getting caught in this wheelhouse. So I just wanted to hear your comments on that.
Thank you. Over here.
Morning, Mike Warra, Stanford University. I wanted to ask you, I've heard a number of comments from both of you about underinsurance. Marshall Fire, obviously, that's a huge problem in California as well. And I wonder, I guess I'm curious how much you see the role of an insurance commissioner to be making sure that people actually have adequate insurance to recover after a total loss.
Okay. If you have any comments on New York, New Jersey.
Go ahead.
Yeah, I think we've been hearing more that there is, I think this is the parts of the system not talking to each other, right? That I was mentioning earlier where, somebody will buy a house and the insurance company will tell them they just won't cover the house at all. What they're meaning is they won't cover the roof. And so making sure that there's I think it takes some friction for everyone to get a little more savvy about the kinds of coverage and questions. And then out of that to figure out, okay, there is actually a problem here and now we need to fix it in this way. But I think I'm just starting to see some of those friction points, and it's something that I imagine will develop, because that, same thing, right? Like the roofs are guaranteed for a certain amount of time and then carriers aren't covering them, and then you're just like stuck in the middle as a homeowner. And, or in the case of the media interview, one of the staff had, like, they had to put on a new roof as part of their home purchase because the carrier wouldn't cover it. And so then the mortgage company was involved because it was a mortgage. And so I think that seems to be new and newer, and you would know as a broker, but that is something that we're definitely watching, because they need to be talking to each other, the different parts of the
Commissioner
system.
Conway, do you want to talk to Mike Warren's question about your obligation to the homeowners?
So we passed the legislation on that front too. So the challenge, right? So the challenge that when you start talking about underinsurance, it is a real challenge, and it's for a variety of different reasons. But at the baseline, when people can't afford their coverage at all, they're going to take steps to decrease the amount that they're paying, and they're going to end up being underinsured. But we passed a piece of legislation coming out of the Marshall Fire that was really directed at trying to deal with what we called the pure competition problem. And what we mean by that is, right, when you have an insurance broker, when you have two insurance brokers that are going to a homeowner, and they're trying to get that homeowner to purchase the coverage from them, if you don't have any like kind of standard baseline requirements for insurance coverage, then they can manipulate the software in a variety of different ways. The majority of brokers don't do this, but if you want to get business, they have the ability to change the estimating software that they're using to come up with a cheaper price, right? So we passed two pieces of legislation. One, to put constraints around what actually has to go into the estimating software to try and deal with that problem. But then we also passed a separate one where we put out a report every year, and we turn that report effectively into a tool so that homeowners have the ability to go into that tool and see what we think as an objective source they need from a fundamental baseline of coverage. But candidly, right, until we deal with the affordability challenge that we have, talking about underinsurance is a secondary problem, right? If we can't get to the place where we're really getting people to the point where they can afford their coverage, then we're always going to have an underinsurance problem. I do think, in my dream world, and I've talked to Ethan about this, Ethan is here from the NAIC, which means he has to listen to all my crazy ideas whenever I have crazy ideas. But right, the FEMA spends a lot of money every year after disasters like the Marshall Fire, after the disasters in California, because people are underinsured. It would be amazing if we could figure out a way to have some shared savings aspects of things, so that if we can get people properly insured, so when disasters happen, the federal government isn't spending a ton of money, and we had an ability to take some of that savings and invest it into things like a reinsurance program or some other affordability mechanism in our states. That's a pipeline dream, obviously, or just a pipe dream. But it's something that hopefully maybe at some point can get some traction.
I think the other thing that I would add is, one thing that I think we have done a poor job of is lumping in what I consider sort of like more normal claims with catastrophic claims. So if your house burns down or you have a fire that is like uninhabitable, like you have the potential to really ruin someone financially. If you have a house that has hail damage, it's like a totally different situation in most cases. Like often you can live in the structure, like sometimes you're taking maybe longer term risk of having some leakage or things like that, depending on the severity. And so I'm a whole lot more sympathetic to having consumers take on a little bit more in those cases, as long as they understand what they're taking on, because you do need to maintain your house and you do need to make sure you're doing that. In the cases where it's just like a fully destroyed structure, or like the storm that I mentioned earlier where windows were blown out, like we were lumping them all together and assuming that we need to have the same kinds of like thinking about both of them, when I think they're fairly different. And I can see, you know, to the affordability point, like it may be, in order to keep premiums low because hail is driving so much, it may be that we need to be thinking about, you know, as long as consumers understand, like that you don't get a new roof every time there's a every time there's a hailstorm, like we'd be getting new roofs every 5 years or less. And so, or you have a fortified roof, which Roy can talk about later, and you don't get as much damage. But I think that's a very different situation than someone whose entire house is like unlivable because they have mold and things like that. And I think the more that we can separate those out and think about where where there's like a collective set of risk between the consumer and the insurer, and where you just need to actually pay claims to get people back into something that's whole, I think will do everyone a service, in particular the industry, because people hate their insurance companies because they don't pay in those situations. When I think the like aggregate claims problem is more the like hailstorm coming through situation.
Right. Please join me in thanking the commissioners for braving the air traffic control system. And introduce my colleague Nellie Lang, who's going to handle the next panel.
On that side. Great, thank you. Okay, we're set. Okay, so welcome to the second panel. And this panel is going to follow up the first, but we're going to start to talk about some potential proposals for addressing some of these issues related to affordability and availability that were highlighted. Just a couple brief points to start. You know, we've had some studies, empirical studies in recent years, which have started to provide some systematic evidence about what is happening to premiums, to affordability and coverage. And studies by Keyes and Mulder that use mortgage data. Senate Banking Committee did a survey. There was a data call by the NAIC and summarized by FIO at the US Treasury. So there's a building body of systematic evidence that in the highest risk quintiles in the United States, we're seeing that insurance companies are getting more claims and by larger amounts. Premiums are rising. They're higher in the higher risk quintile areas rated by risk, and they're rising more. And that we're having non-renewal rates and cancellation rates rising by more in those areas. And so homeowners are becoming increasingly vulnerable to issues in insurance as costs rise. But some see this as a crisis, some see more nuance in the data, and I think we want to address some of those issues. For example, the premiums are rising most in the highest risk quintiles. There's not as much less dramatic change in the lower risk quintiles. So how you want to address these issues is an important issue that we'll get to. So this panel is going to focus on one possible solution, which is reinsurance. And it's not for the primary homeowner insurance, just to be clear, this is reinsurance. And we have this terrific panel to discuss this possibility of reinsurance. First, we have Ben Keyes to talk about a proposal by Collier, Keyes, and Mulder to create a federal reinsurance program in the United States. And this paper was released this morning. We have Adam Solomon at NYU, who has a new paper that has reviewed public reinsurance programs in different types of reinsurance programs in the US and in other countries. And then we have Tom Holschuh, chief economist at Swiss Re, to talk about the current state of private reinsurance companies. So I'm going to start with some questions to let them summarize some of their work, and then we'll do some follow-up, and we'll leave some time for Q&A at the end. So I'm going to start then. So maybe I just open with, what is the case for a federal reinsurance program, and what specific problems would it help to solve? Why don't I just open with that and leave you with it?
That's great. Well, thanks, Nellie. It's great to see you. And I want to say thank you to Brookings for hosting this event. Brookings is a special place for me because I started my career here now almost 25 years ago as a research assistant, usually standing somewhere in the back of these types of rooms. So it's especially fun to be in the front of the room. But Brookings is also a special place in that it's convening policymakers, regulators, academics, and the industry to think big and to think in a much more open kind of way and to have these dialogues. And so when the opportunity arose for us to think big, we jumped at the chance to do so. And so this is kind of, you saw, if you got here early, you saw the trailer for the paper when you came in, but the paper is now posted and available on Brookings' website. And this is a true collaboration with my co-authors who are here today, Ben Collier and Phil Mulder. Where I come from in thinking about this is thinking about the stability of housing and mortgage markets and the enormous social value that insurance provides. We have a $55 trillion housing market, according to the latest numbers from Zillow. We have about a $14 trillion mortgage market, and those markets simply don't function in the absence of available and affordable continuous insurance coverage. So when we're thinking about the difference between sort of the private value of an insurance policy and the social value, we have to take into account that those markets simply wouldn't operate. When we think about the value of insurance, we think about the benefits to households in a claim, but we should also be thinking about the knock-on effects when it comes to their ability to make mortgage payments or to make their credit card payments, other financial stability aspects, the general benefits of improving the community, and then as we heard from the commissioners in that excellent discussion just a moment ago, the benefits in terms of reducing the burden on local governments, on state governments, and on federal governments. And so all of this points towards having an insurance market that is providing insurance that is continuously available and that is affordable at a point that households can afford. And you sort of rattled off some of the statistics that we found in some of our work and in others where we're seeing an insurance market that's in turmoil when it comes to providing insurance at a reasonable price and providing continuous coverage. We're seeing households that are struggling to find an insurance policy that provides them enough coverage. That's creating these protection gaps that were discussed. And that's where we think there's room for intervention in this space, which is to think about the drivers of that protection gap. And when we think about some of the different sources, we've seen increased frequency and severity of disasters. We've seen inflation in the terms of the cost of materials and labor, but we've also seen big shifts in the availability of capital in this space. And that's where reinsurance comes in. We've gone from an interest rate regime where we had basically zero interest rates to one where the cost of capital has risen 200, 300 basis points. And we see a market, a reinsurance market, which is insurance for insurance companies, that seems to be perennially fluctuating through hardening and softening cycles. And what that means is a market where capital is kind of freely available and willing to write these policies more generously to protect insurer solvency, and markets where it's difficult to find that capital. And so what we propose in this piece is a federal, basically a public option, a federal reinsurance entity that we've creatively named US Re to sort of provide this role in the market that I think is in the trailer as well, that kind of acts as this shock absorber that in order for households to have this continuous coverage that they can afford, insurers need to be protected from the kinds of insolvency risk that they rely on reinsurance markets to provide. And when those markets are tight, we can then rely instead on a private option. When we think about some of the design elements of this proposal, we can think about this as ideally trying to crowd in private capital, so actually giving more space for insurers and reinsurers to operate and taking only the most extreme catastrophic tail risk off of their plates when it comes to the kinds of risks that the government can hold most efficiently. The government has a cost of capital advantage, has a very long-term commitment to providing support for communities across the country.
and ideally can bring down the extreme cost of capital challenges that insurers and reinsurers face from these extreme tail risks where they're often paying a large multiple above the expected losses. So the idea is not to subsidize risk or send bad price signals to households, but to address this very specific challenge faced by insurers and reinsurers. And this is not a new challenge. In the wake of Hurricane Andrew, there were proposals, bipartisan proposals, in the House of Representatives that were filed in, I believe, 1995. Bills proposed to do almost exactly what we're describing in this piece, and this is something that has come up again in the 2000s after Katrina and currently in congressional discussions. And so I think this is a recognition of an extremely volatile market and one where we think the government can bring values closer in line to the overall social value.
Terrific. That was all the goals are absolutely in line with the issue will be all the details, which we'll get into a little bit more. So Adam, maybe you could get us going on. You've studied a lot of public insurance programs in other countries. What are some of the features that are important about them that could be helpful in the U.S. situation?
Yeah, thanks, Nellie.
Sure.
So I'm a big fan of the U.S. RE proposal, and I think it really hits most of the points that have proven to be successful in other countries. I'll just highlight a couple.
Please.
So public reinsurance in different countries or in some parts of the U.S. for different risks, like terrorism reinsurance and things like that, have tended to work best when I think two or three criteria are met. So the first, as Ben's highlighted, is there needs to be sort of risk-based pricing. And that means both in terms of where the risk is today and where it might be tomorrow. Households need to sort of understand the risk they face, notwithstanding the very important affordability issues that we've talked about today. And the sort of converse of that is if the program is mispriced initially or there's a subsidy or cross-subsidy built into it, it seems very, very difficult to reverse that in the future. There's nothing inevitable about this, but experience from the National Flood Insurance Program and things like that have meant that unless you get the pricing and you set expectations right initially, it's quite hard to change that in the future. So that's pricing in terms of where risk is today, but echoing the discussion we've had earlier, a public reinsurance program is also a great opportunity to build in very clear risk mitigation pricing incentives. And there's both the direct signal that you can give in the public reinsurance price that says if you take a particular action, the reinsurance premium and then potentially the insurance premium falls by 10% or 20% or depending what it is. But it's an important political signal as well by making this very public statement that these are the kinds of actions that can reduce your risk, and by this much, this can hopefully induce households and insurers to sort of engage in all of this. So risk-based pricing, I think, is far and away the most important thing that keeps these programs solvent. I'll just highlight one more factor, which is to try and encourage as much participation and as broad a risk pool as possible to enter these reinsurance programs. So to the extent they're very localized or they benefit one geography or risk-exposed set of policyholders over another, there's both economic issues and political issues potentially. For these reinsurance programs to work as well as they can, you would ideally like to have many different risks and many different geographies so as to maximize the diversification benefits and the risk smoothing benefits and this kind of thing. And I think that perfectly that helps to create political buy-in as well, where it doesn't seem like one region or one geography is benefiting at the cost of anybody else. And so the US RE proposal to cover many sorts of risks, in the entire country would bring together a sort of patchwork of sort of local programs that are trying to approximate this, but hopefully with much more political buy-in and economic benefits because of the risk diversification and the risk pooling.
Mm-hmm. Could you just say a little bit, one of the examples you focus on is the Florida reinsurance program. And could you just say a little bit about participation in that, how that would, some of the lessons that would apply for US RE?
Sure. So I think what US Re has proposed as well, and Ben should correct me, he wrote this, but focusing specifically on the tail of the risk, the sort of most catastrophic, is a lesson taken from Florida. And I think that would hopefully induce the crowd in that the US Re proposal is looking for by leaving the private market to sort of cover the middle tail of not quite catastrophic risk, but almost there, and freeing up public capital to sort of get the most bang for its buck on the most extreme events that the private market finds most difficult to cover because of the capital costs and the correlation would be an example. Another benefit that I think is related to the Florida experience is that Florida was sort of a pioneer in public modeling, in generating and encouraging the use of very cutting edge hurricane models in the premium setting process and in the reinsurance setting process. And as a result, there's been a lot of visibility. There's been a Florida public hurricane model. There's been all sorts of things these goods that have public value because they free up information. They allow for more transparent price signals and risk signals. And so to the extent that a sort of incidental benefit of US Re would be a much more vibrant and public modeling ecosystem, I think the Florida experience speaks well of that possibility.
Okay, great. Tom, can we turn to you and can you tell us about the current state of the private reinsurance sector and its ability to provide reinsurance to primary insurers in the U.S.?
Yeah, sure. So let me start maybe by trying to explain how the reinsurance market fits into this narrative or the story of the recent increase of homeowner premiums. And I agree with the diagnosis there of what has been previously said and in the papers you quoted. We have, if you look at what drives a homeowner's premium dollar, it's 75% is claims driven. Right? And then we have about 26%, and I'm talking 5-6 year average of so different levels of catastrophe occurrence. But on average, it's about three quarters is claims costs, and a quarter is then administrative expenses and claims handling and so on. So and distribution. So this is where we disagree with regards to the role of reinsurance in driving costs is that reinsurance, if you actually look at how the payments flow and the reimbursement, most of the reinsurance premiums flow back to the industry, to the cedents in terms of claims payments and what's called ceding commissions. So it's in a way it's the same thing. Reinsurance, most of the premiums are also claims driven, right? It is driven by cost of the insurance system. What remains, and that's one of the questions at hand, is the cost of capital. And there actually, if you look at it, the underwriting related cost of capital on average is probably around 2% of a primary insurance policy, right? So it's not really one of the major drivers. Also, I mean, this relates to maybe some lack of transparency of that reinsurance market. It's a wholesale market. It's not very, it's very fragmented. But the price increases, these price indices that are often quoted are these non-proportional property cat index, but that's only half of the property cat reinsurance market. The other one is proportional, and the price swings overall are not that extreme, and also have peaked. They have been going down for 2 years now in a row and keep going down. So there's cyclicality, but it is something that is actually rather also reflective of this cost shock, right? And I think this is where we need to differentiate. There's the last 5 years, homeowner premiums went up some 40%, and so did construction costs. Yeah. So and they have plateaued. They haven't come down. So this is home building has become has a reset price level that is significantly higher. So that's a cost of owning a home. It's either new construction or rebuilding is more expensive than it used to be, and insurance and reinsurance is just transferring the risk of an event happening to one policyholder and not the other one, but it cannot change this level of higher construction cost. In the long run, and that's very important to the theme, is that this loss cost, $0.75 of the dollar, is now 50% of that is catastrophe driven. Used to 20 years back, it was more of a third. So this is systematically growing. So in that respect, it's really important to take on this trend. Cat losses, they grow 5 to 7% in real terms, even adjusted for inflation. And so this is in the long run the main driver of insurance premiums. It's not the inefficiency within the market, but it's the underlying claims cost, which is the key driver.
Mm-hmm. And could you just say a little bit about how currently private reinsurers are working at state levels? So there's a lot of differentiation across states in terms of reinsurers and primary insurers, and how do you which states do you go into? What are the attachment points? Is there anything to add on that? You don't operate at a national level necessarily. You have regional insurers and national insurers and state level regulations. And how does the private reinsurance sector work in the country right now?
Well, we operate with insurance companies in all states, mm-hmm. and with all their regional footprints, right? The majority of the market of reinsurance market is focusing on the very big catastrophes, where we have a hurricane, $30-40 billion loss in the U.S., the California wildfires. Mm-hmm. So some of the peak risks that are not where the diversification of risk doesn't work within the U.S. market, right? So that's the majority of the reinsurance market. That's a lot of the so that gets then transferred and diversified on an international level, right? And this is something where the insurance market, and when you mentioned the prior capacity shortages or crises, Hurricane Andrew, Hurricane Katrina, but the market has changed dramatically since then. Is the flexibility of capital coming in? Mm-hmm. So there was and it was this opening to international investors, Bermuda startups. That was after Hurricane Andrew. Then all these cat bonds, sidecars, a lot of alternative, and this part that was a big surge after 2005, and then again. Somewhere around 2014-15, there was another rush in of this additional capital, and that takes on very specifically these peak risks, these peak scenarios. And in the U.S., the main peak scenario is Florida. Right? This is the biggest, globally the biggest risk scenario. High property values, highly populated in a peak hurricane zone. But it still is something, if we try to orient that in terms of numbers. The estimate is somewhere around $9 billion in premiums annually in Florida for the property cat risk, and that relates to a global reinsurance market of some $375 billion. and a big chunk of, and a part of this goes very specifically into these alternative capital, cat bonds and sidecars. It's about 120 billion. It takes on very specifically a big chunk of this Florida, of this U.S. windstorm risk.
Okay. Not to oversimplify, but I want to open this up. I think you're maybe suggesting cost of capital is not as big a factor in the availability of reinsurance, but I'm interested in how important that factor is in providing a federal reinsurance program. Just open this up to the others as well. There's a premise of which government cost of capital is lower than private, especially in the face of catastrophic losses, potential risks that are not totally quantifiable at this point. But there are some other advantages to federal reinsurance. But I was just, could you just talk about that a little bit, Ben?
Yeah, absolutely.
Some of the other advantages and how you would achieve those if.
I mean, I think when you look at pricing of insurance, you can think about that as reflecting these expected annual losses, the sort of the claims that Thomas is referring to, and then you can think about the other associated costs that go along with that. One of the pieces is that there's just a tremendous amount of uncertainty in the models, especially as you start thinking about the risk in those tails, and you basically need to compensate investors for the potential for a pretty wide range of potential outcomes. And there's also this insolvency risk that firms don't want to go out of business, and so they're hesitant to write policies in ways that would concentrate their risk above a certain threshold. And it's those kind of elements that lead the cost of insurance to be marked up well above the expected losses, and disproportionately so in the areas where there's more concentrated correlated risks. So we see the role for U.S. Re is not a silver bullet to solve every issue in the homeowners insurance market, and Adam sort of alluded to some of the other directions that you could imagine going in terms of incentivizing mitigation and others. We see it as being sort of focused on this piece regarding the markup relative to expected losses, and in some parts of the country that's a small number, and it's probably not going to address the challenges that are faced there. Although the availability of these policies could potentially crowd in other players, even in those markets. When we hear stories from some of the commissioners saying, well, the reinsurance doesn't kick in until some additional point, and so it's not providing value. Well, maybe there is a role where a government-provided program could be in that space. And so this is more of a kind of a missing market story about where we could see a public option that's appropriately priced and potentially create new players in the market, bringing a model into the space as well. If you think about the barriers to entry in this space, we haven't seen Bermuda 2.0 as premiums have risen as sharply as they have, and you think, well, why aren't there a bunch of competitors racing in? And some of that is that's just very difficult to scale, to invest tens of millions of dollars in data and models, and to build up a capital base where you can actually manage those large risks. And so I think all of those things are ways in which having a federal player in this space could help quite a bit.
And just to follow up on that, what are like the most key attributes of the federal reinsurance that would make it successful? Just to make sure this point's come across.
Yeah, so I'm not a lawyer, so we haven't written a bill. There's no draft bill that's associated with this. This is a team of economists thinking big about supply and demand curves and some of these other issues. I think to translate this into implementation, we sort of focus around three principles. Yeah. One is regarding the pricing of risk, and that was to Adam's first number one with a bullet, right? We want to make sure that this is not subsidizing living in risky areas or developing in risky areas. Number two is targeting the market failure and allowing private markets to thrive alongside this public option. The idea is not to crowd out the either activity of the insurer or the reinsurer level, but to crowd in more competition, more players, more innovation. And ideally, that's where you're going to see premiums being driven down. We think that those are, the relationships that households have with their agents, with their brokers, and with their firms is not something that we think should be disrupted. And I think this is another lesson from the NFIP, which ties into our third principle, which is about political independence and creating an entity that is, really motivated by actuarial evidence and not political boundaries or political interference. And that's obviously much easier said than done, but we're allowed to say that and then say go to it. But I think that's one of the additional advantages of designing something that operates at this higher level of the risk transfer chain, is that it's removed from homeowners. And so that potential for more direct involvement in terms of the pricing and the availability would be at least one step removed from some of the political machinations.
Right. Great. That's terrific. And can you just, to clarify for people, just exactly which market failure is this targeting? Like, for example, you will hear from some that, the costs of homeowners insurance is rising because replacement costs are rising and the severity and frequency of events is rising. But if premiums rise because of that, that's usually not viewed as a market failure. But you're very clear in your paper, so I just want to make sure that you get a chance to explain what market failure this could address.
Yeah, absolutely. I mean, we think of this as this issue of a gap between the social value and the private value as not. So that's the different. That's sort of a motivation for government involvement in this market. I think of the incredible pressures that households are facing right now with affordability and availability challenges as a market failure, given the demand for continuous coverage. That's just essential, that you have to have. If you have a mortgage, you have to have continuous insurance coverage. And so you could think about the protection gap writ large as a market failure. I think there are a lot of different ways to frame that, and it does ebb and flow as market conditions move. That's certainly the case, but that's where we see this as potentially solving that problem.
Okay, great. Adam, when you were reviewing some of these other programs, you tried to come up with metrics of what makes it successful. Could you just talk a little bit about how you measure success of a reinsurance program?
Yeah, definitely. So, most of as we've talked about, the U.S. and Florida in particular is actually, some of the hardest problems to solve when it comes to reinsurance, because it does make up such a high proportion of the global catastrophe risk. And so the numbers I can tell you come from programs in countries that are actually a much smaller proportion of global catastrophe risk, and therefore for whom you would think the private reinsurance market is already working quite a lot better, because it's much easier to diversify Japanese earthquake or Australian cyclone risk relative to Florida hurricane risk. But in those countries and in those programs, what you see is the private reinsurance prices relative to existing loss prior to these programs might be in the order of $2 to $3 of reinsurance cost per dollar of expected loss. In Florida, there's some evidence that it's closer to $5 or $6 or $7. But then when you bring in a public reinsurance program that prices closer to expected loss with a small allowance for administrative fees, you get price reductions of something like 20 to 25%. Again, these are in sort of smaller, less catastrophe-prone places than Florida and the U.S. in general. And then you get availability increases. In other words, you crowd in primary insurers also in the sometimes 10, 15, 20%. And there's obviously a symbiosis between these two. To the extent you can catalyze competition in the primary insurance market by allowing primary insurers to have a sort of reinsurance access and that allows them to write more policies, the competition in the primary insurance market that we've alluded to before as potentially leading to more mitigation and lower prices and all these kind of things can compound as well. So it would really be the two metrics would be lower prices and more availability, more insurers in the space.
That's terrific. And Tom, maybe you could just speak to how would a federal reinsurer need to price to not crowd out. I mean, a key feature here is we want to crowd in primary insurers and private reinsurers. And like, how do you see that? How do you see private reinsurers working alongside a potential public reinsurer? What's important to keeping the private reinsurers in the space?
Well, the risk-adjusted pricing is absolutely key, right?
Yeah.
And it's kind of the premise of the proposal, but then it's also, I would say, it's also the weakness of the proposal to assume a structure that can withstand political pressures to stay independent. And if you look at the existing examples, and for example the Australia Hurricane Fund, it is explicitly set up to provide average premiums, to not so there is a cross subsidization is part of the design, and you find this, it's in the NFIP, you find it in the US, in Florida in the market, you find it in the California regulations, you find it in flood re in the UK. If you want to address the affordability issue, and they are all set up for this, the main problem is not the average, and it's I'm going to talk about the cost of capital again, but it's the peak areas, right? And so you cannot solve the issue of affordability of peak areas in an insurance setting if you don't average the premium load, right? So all basically there, as soon as you set up such a mechanism, there will be political pressure to do so. Right? And so I think this is just it's a very narrow path intellectually to think that in the US you will be able to set up an agency that will remain independent of political pressures. I think the practice is otherwise. But I want to go back to this the necessity for it's so important because the cost of capital is not the main driver, right? And so the notion that the model uncertainty is so much driving capital cost. The model uncertainty is the lowest for the peak risk, right? So for the hurricane, the model uncertainty is actually quite low. It's the wildfire and the severe convective storm models that are much more complicated, the hail, the tornado, and where models are evolving. But these are not on a global level. These are not the tail risks. So these are actually risks that with all the uncertainty, they diversify, right? So it's really the earthquake, California, Japan, and Florida hurricane that are further out. So that's I would say the uncertainty is not the key driver of cost of capital on average in a reinsurance market if you let it play out. Also, the risk surcharges are not a multiple of expected losses in the reinsurance market. It's very small, far out, and most of it, if you look at the academic literature on that, it's very old. It's 20, 25 years old, the observation of this data, and that was not a functioning market at that time. So overall, this is not that's not the key driver. It is the losses and the dispersion of the losses, right? And if you want to have risk-adjusted pricing, then this is not going to be solved. Yeah? If you want to cross-subsidize as a policy goal, then this is a different discussion. Right? It's one to be had, possibly. But let's separate these issues.
Any comments?
Can I add just one quick thing? When we're thinking about this changing capital landscape and the growth of the cat bond markets, ILS markets, I think of those as growth in that space, sort of financialization of the space to remove some of the various frictions and fees and other things associated with
reinsurance. And so if those are a cheaper option than the reinsurance path, you're going to go down that path. But when we look at where we can actually see pricing, we see pricing that is well above expected loss and oftentimes a multiple above expected loss. And so by revealed preference, that means that the players in that space are willing to operate there rather than others. And there's lots of nuances here in terms of exactly where this proposal would bring down costs. But if you really focus in on these most extreme tail risks, we think that's where the pricing has gotten most extreme, where we've seen the biggest constraints for availability and affordability. And if we can target that area and address those kinds of issues, that's where we could see this crowd in, we think, happen most actively. And certainly the role of a public entity that is immune from meddling is aspirational. But we recognize that, and it's something that we think that we should start as the goal with any proposal like this one.
So I'm going to do one more question, and then if people could be prepared to ask questions, and we'll take a couple at a time.
I think we're out of time.
Running out the clock. I'm going to go to the audience.
Got it. Okay, so questions from the audience, and we can take a couple at a time. Right here and back there.
Good morning. Thank you very much. Dave Snyder, American Property Casualty Insurance Association. First, a very quick general comment. The fact of the matter is that the market is stabilizing for both insurance and reinsurance in the United States, and that's a positive thing that we ought to be talking more about. But here's my question. Despite good intentions, government backstops have often led to underpricing the risk, which has resulted in taxpayer or insurance company bailouts. Worse yet, the underpricing of risk creates the impression that the problem has been solved and governments fail to do what they need to do to fund infrastructure, to fund emergency response, to have good building codes and land use effectively enforced to deal with inflation, lawsuit abuse, et cetera. So my question, other than saying it won't be so with the U.S. proposal, what are you actually going to do to prevent a repetition of the problems that have occurred in areas such as the National Flood Insurance Program and the California FAIR Plan?
Okay, great. Thank you. Question, and back there?
Hi, Sarah Edelman, National Community Stabilization Fund. Thank you so much for the big thinking here. I want to bring it back to homeowners for a moment. And actually, I referenced some of your recent research, Professor Keyes. We know that in some parts of the country, if somebody's low income, if they have a lower credit score, they're going to pay twice as much for their insurance, even if they have the fortified roof, even if they have equal property risk. This is an issue for homeownership, and this is an issue for the risk that the federal government is holding, because the FHA is the backstop for lower income homeowners. So tell me how your proposal would fortify, no pun intended, sorry, the sort of the homeowners of lower means who are being hit hardest by insurance volatility.
Okay, why don't we take those two? Do you want to start on how would federal reinsurance help prevent where we are in some sense, and does this address distributional issues?
Yeah, I'll try to take both of those briefly. I mean, first, I appreciate the question. I encourage you to read the full proposal in the ways that we're thinking about ensuring that that risk is accurately priced. We're not thinking about this as a government backstop of the market. This is an option, and that there's a difference there. In terms of when this market would be most active, would be when capital dries up, when we face the shocks that we see to these markets. It's not, the idea is that it would be a countercyclical shock absorber rather than, would take over the market in the way that we've nationalized the mortgage market in the U.S. That's not the idea, right? In terms of the work on credit scores and the distributional impacts, I think what we're seeing there is that this current cycle of insurance availability is just amplified for for the lowest credit score households. And we're seeing enormous insurance burdens. If you think of just the share of the monthly payment that's now going towards insurance as a component of principal, interest, and others. This is an acute problem for homeowners. We're seeing that play out in terms of mortgage repayment rates. If you look at the latest data from Black Knight on non-current mortgage rates, you're seeing a huge increase in delinquency, mortgage delinquency in the Gulf in particular. So I think this is playing out in extreme ways for that population, and my hope would be that a program like this one would be especially beneficial to that group.
And I'll just briefly add that even though it's been one of our cautionary tales, the sort of National Flood Insurance Program's historic subsidization and underpricing, it has recently moved towards actuarially fair pricing. And as a potentially optimistic example, that has led to the emergence of a private flood insurance market for the first time. And so, there is definitely room for the crowding in that the US RE proposal hopes for when you do, through in this case after a while, but nevertheless get to risk-based actuarially fair pricing on the public side. This helps catalyze the room for proper private market competition.
Okay, Tom, anything?
If you don't do risk-adjusted pricing, then you actually, I think that's the main cautionary caveat here. Then you actually are detrimental to the risk mitigation goal in the long run, right? And this is, for me, my point of view. This is the one to keep the eyes on primarily on the ball. This is the big driver of the losses. 5 to 7% loss growth is not affordable. It's obviously outrunning incomes. And if the reinsurance market is not setting the right incentives, then we actually are not working on the risk mitigation there. The savings to be had, and that goes back to my stat from the beginning, 2% of premiums on average. You can only take them out once, right? But the claims growth that adds every year, so it's just the risk that you disincentivize mitigation, I think, is far outweighing the potential savings on the cost of capital side.
Okay, great. Okay, let me thank our panelists and today for a really very in-depth discussion with lots of specific proposals and details. Very much thank you. Thanks.
Yeah, sit there. Sounds good.
She has an order. We'll find out what that is here in a second.
Okay. Assign seats. Let's get started because we're a little bit behind time here. So we're gonna have a conversation now about stabilization of insurance markets, but the degree to which we can use the market and efforts to stabilize the market also to help improve recovery from catastrophic events. And I've got an incredible panel to talk with us today about these issues. Sitting directly to my left, or I guess my right, where you are, Judd Boomhauer, who's an associate professor of economics at UC San Diego. Beside him, Rebecca Diamond, the Martin Feldstein Professor of Economics from Harvard. And on the end, across, is Roy Wright, the president and CEO of the Institute for Business and Home Safety, a leading nonprofit in the, as we've heard actually already quite extensively about today, in the development of standards around resilience and home resilience. I'm going to start off with a question each for each of the panel members to allow them some time to share their perspectives on the sort of broad issue of resilience and the role of insurance in creating and incentivizing resilience. And I'll start with you, Judd. And I think this picks up on the kind of many of the conversations we've been having today. But I think it's a good place to start is to ask, how much can pricing solve this problem? We've heard a lot today about actuarially sound pricing. I'm a huge advocate for that in insurance markets, but we also have to ask and really look at the extent to which getting the prices right drive investments in the physical world that change risk. And I'd love to hear your thoughts about the extent to which that's happening, what we see happening, and also the limits.
It's such a great question. So yeah, thank you for having me. Really happy to be here. You've got a bunch of economics professors on the panels today, and we're going to tell you about how great pricing is. So you can interpret that according to your priors. There are a lot of directions to take this question, and it's really important. I want to unpack sort of a few parts of it, starting with why, I'm an economist, so let me start with what you don't expect me to start with, which is why might markets not be able to solve all of this on their own? There are a number of reasons that insurance pricing and mitigation and investment is complicated in a way that interferes with our sort of like standard economic notion of set prices and let people respond to prices and everything will work out. And so at the outset, let me acknowledge those. One really important one, I live in California, so I think a lot about wildfire risk. In wildfire risk, there's really important spatial dependencies and what we call externalities, right? So the choices I make about how to mitigate my house have implications for whether Michael's house is going to survive or not if he lives next door to me. So that's like a classic reason that we think we want some intervention and something other than reliance on pure individual price incentives. We're also understanding that sort of community scale mitigation is more important. We also have, behavioral economics evidence that we need to take seriously, that people don't always correctly perceive prices and respond to prices in a super rational way, the way that I'm used to modeling them as doing. So like all of those stipulated at the outset, those are really important things, and they argue for building codes, they argue for mitigation subsidies, potentially in some cases. I have work about the value of building codes for wildfire. So certainly, like, insurance pricing is not going to get us all the way there. Now, having said that, let me make the argument that you thought I was going to make about the value of insurance pricing. I do think that there is, that there's a lot we can do, and it is important, echoing the previous panel about setting prices to reflect risk. It is important to do that. And I think one of the things that's been interesting for me as I've been working more and more on homeowners insurance and catastrophic risk is sort of the evolving understanding of how risk is priced in these markets. So that I think as of a few years ago, kind of the conventional wisdom among at least the academics as we started to wade into these markets is that risk isn't priced in the sense that there's a ton of cross-subsidization, that everything is, that individual home prices are decoupled from the risks that face those homes. And that was a confusing set of findings in literature. I think some of the more recent stuff is starting to indicate that once you're able to work with the more detailed models that the insurers are actually using when they set the prices on these policies, that risk actually is pretty priced in a lot of these markets. Certainly in Florida is a place that I've been thinking about recently, and spatial hazard for hurricanes is pretty priced in the Florida hurricane market. Mitigation is pretty priced. Where we live in California, the spatial hazard for wildfire is starting to be priced more granularly. Mitigation is still not really priced for reasons that we can talk about. So I guess one observation is just there is pricing, and I don't think we need to kind of give up on it in the way that we might have thought. But then we need to engage with a bunch of questions about how do we preserve those price incentives while protecting affordability. And I'll stop filibustering now and turn to Rebecca.
Thanks. Rebecca, I wanted to ask you, so we've heard today about the challenges with affordability on insurance, but like in a perfect world, people would be able to afford insurance and have adequate coverage, such that after a disaster, their rebuild costs are covered. Is a homeowner protected in that context? What is the role of an insurance company in helping homeowners, households, and ultimately communities recover from disaster?
So I think this is a super important question and a point that is currently understudied and we don't know as much about as much as we'd like to know. So we're all talking about pricing, which is about when you're buying your product, your insurance project, how much should you pay? And this is related to, in the state of the world where this terrible thing happens to you, that it's going to recover this huge loss that you would have had otherwise, right? Insurance is about transferring income from a good state of the world where you have money to a bad state of the world where you need more money. And we share across each other. We all pay the premium in the good state of the world, and then we all pool our money toward the people that need it in the bad state of the world. But unlike, say, like unemployment insurance, where it's sort of easy to verify that you lost your job and how much you deserve in the state of the world where you lost your job is just sort of a formula, home insurance payouts are much more of a negotiation with your insurance company. And in the actual state of the world where your house has been destroyed by a wildfire or any other catastrophe, that moment you don't actually know how much you're going to get paid. You have some number in your insurance premium or policy that says, like, coverage A, this is what you're insured against. But you have to decide whether you're actually going to rebuild the house or not, which determines how much money the insurance company actually has to pay you. If you actually rebuild your house, you have to jump through a lot of hoops to get quotes from contractors. You have to follow all this sort of bureaucracy to actually get the money from the insurance company. So I think there's a big open question in how much of a role is the actual insurer playing in how easy it is to actually access that capital in the state of the world where you need it. And you would think, so insurance companies, they have their claims data. They know exactly how they decide to pay out claims and who they say yes to and who they make go get more paperwork or try to kick down the road and hope they'll stop asking for money. But we as researchers have no access to this data, the claims data, which puts this big sort of gap in our knowledge, which is we're all saying, how much should we pay for this insurance product? But if your insurance company happily pays claims the first day someone calls you, and my insurance company tries to just put up a bureaucratic wall of endless, phone conversations and fill out this piece of paper or that paper, we actually may offer very different insurance products, even if on paper they look very similar. And we know so little about how easy it is to actually access that capital. And I think it's as first order as premium coverage discussions. It's just a much harder question, I think, from a data and even from an analysis perspective that there's lots of data on premiums. We all pay premiums. There's lots of samples, hundreds of thousands and millions of homeowners. We have very few people that relative to that size that actually lose their house. So it's much harder to actually be able to measure these things super concretely. But it's the most fundamental thing in terms of what are you buying? You're buying a product that pays you in that state of the world. And we don't actually know if people are getting paid well. So I think understanding the insurer's role in the recovery process is as important, if not maybe even more important than the premium. It doesn't matter what you charge if you're never going to get paid. You shouldn't buy the product then. But if you're actually going to get paid, then the value of that premium is very, very different.
Thank you. Roy, your institution, IBHS, has really been a leader in setting standards and working with states to try to drive mitigation at scale. A central question in all of this, we're talking about houses that people own. People who own houses tend to be wealthy. Local, there's got to be a private role in funding mitigation. There's also, as we've heard on the fire equation, there's community mitigation that's really important. What is the right, or in your view, how should we be thinking about the balance between private incentives for mitigation and the government's role in, providing resources or incentives to drive mitigation at scale?
Yeah, it's a big country, and
what I'm going to try to do and keep it fast is we've got a segment based on what the peril is that's in question. It doesn't, conflating them actually gets us in trouble. So let's take wind. Wind side of the equation, so deal with both elements of wind and hail, but asphalt shingles are the predominant roof cover on residential homes in the United States. There are only 2 countries in the world that rely on asphalt shingles. In the world. The United States and Canada. You can't find it in the third world, you can't find it in Asia, you can't find it in Europe. No one else does this. Why do we do it? Well, because it's a cheap product. It comes with a set of warranties. If you read the contract, once you take it out of the wrapper, the warranty's done. If winds exceed 90 miles an hour, the roofing manufacturer has no liability on that. Okay, well, we know that a metal roof, we know that tile roofs perform better, they cost more. And so consumers keep returning to something that in the near term they can address. We know how to put roofs together that can withstand 135 miles an hour. They just cost a bit more. Hail. If you're in a hail-prone area, there are impact-resistant shingles in the asphalt shingle space. They don't eliminate the hail risk, but they can skip a replacement cycle. That'll help you down that road. And they cost about 30% more. In both of those instances, we look at the piece that goes, okay, what does it take to get there? Is there an endorsement that the insurance company can offer, or are there other incentives? And so we've looked a lot at Alabama and how they've done pieces in their system, particularly on the wind side. And yes, they've got a grant program, and many people want to repeat the pieces that are there. They do have discounts that are prescribed. A good number of the insurers actually exceed those prescribed discounts because of the value they see in that place. But in a place like Alabama, where there are 50,000 certified fortified roofs, only 17% of those tie back to a grant. 83% of that is happening in the private market. And so the real point is, how do we use some of the grants to seed the pieces, and maybe particularly focus on those who are less likely. But in both those cases, when you do it, what's your discount going to be? How much does it come down? And oftentimes consumers want to see a one-for-one payback. If I make this investment, how many years will I see it just in my insurance premiums? Finally, to wildfire. Well, wildfire, we do need people to take action one parcel at a time, but 2 parcels on the block has not actually changed the risk at all. Someone's got to go first, and so we need to nudge and even incentivize them down that road. But in an average block with 22 homes, we need 80% of them to have done the right thing, to actually have bent down the curve when we're in a suburban neighborhood. Talk about the commons in play that is here. But a California example. Statewide, the average insurance premium for a single-family home might be around $2,600. Let's hypothetically say that they're going to get a 10% discount for doing the right thing. Okay, $250, $260. To address the defensible space landscaping changes in most of these homes, it's somewhere between $6,000 and $9,000. And they look at you and go, well, no thanks. And so we get to that point that unless there's a baseline in policy at a state or communal level, you're really at this point where you're trying to get 22 homeowners to go do the right thing, one house at a time, for a piece that if your home survives, that might be priceless. But I do think this is an element where we can use grants to incentivize down the road, but if we don't change the baseline of expectation, we'll have taken insufficient action to actually change the outcome.
So, thank you. I think these comments actually connect back to where Judd started, which was kind of how much can we reasonably expect prices to drive mitigation? And I'd be curious to hear from all of you if we need good work in economics done in the insurance space. But where do you see the greatest return from other disciplines in thinking about how to motivate this non-price-based behavior? Is it that we need to see more social science done about other kinds of social science, about other types of persuasion? Is it in terms of understanding, evaluating some of these programs across different dimensions? Where do you see the largest return or the largest gaps in our understanding of how to get to those 22 homes on a block, or I guess 18 of them?
I'm going to answer that tangentially, and I want to build on something that Roy said, which I think is really important. Starting to get into this question of, we have a lot of cases where the discounts on offer from the insurer are substantially less than the upfront cost of making a mitigation investment. And one of the questions that I would like to see us wade into a lot more seriously is, which are the mitigations that actually pencil out and which don't? And there are a lot of reasons that insurance discount might be smaller than the cost of doing it, but the thing might still be worth doing. For example, the neighborhood values that we were just talking about. But it's also possible that there are cases where the risk, the hazard, the probability of the bad thing coming through is so low that it may actually may not pencil out for that particular home or that particular neighborhood to spend a bunch of money on mitigation. And so I think I would like to see a lot more serious research on that, sort of understanding how do we develop not only codes, but really carefully targeted codes so we know where we're making people do these things, it's a good thing for them to be spending their money on. Now, of course, that's really hard because there's a ton of fundamental uncertainty about these perils, right? And so my answer to Michael's question is I am really excited by all of the progress that I see in the natural science and catastrophe modeling and engineering communities in hopefully building better and more precise models. And we're never going to fix that problem completely, but that's where I would really like to, I hope to see a lot of progress in the near future, is better models, and also just all of us being more honest with each other about what we really know and don't know from these models and what the fundamental uncertainties are.
So related to what other social science contributions could there be to help understand this pricing or lack of pricing or lack of mitigation? I mean, we know from many different contexts that people are really bad at valuing low probability events. This is, even in a place where it's a high risk event, it's still probably not going to happen to you, right? It's still a very low risk. It's not a daily occurrence, weekly, monthly, yearly. So it's hard for people to really make that conscious trade-off. The premium reduction, that's, probably you get it. So that's much easier to think about that trade-off versus probably lots of the negative consequences of your house burning down. Even in the best state of the world where the insurance pays you the full contract, like your life is turned upside down, right? You face a huge risk that is completely uninsured even with the best home insurance contract because it's just miserable to go through all that. And even with that benefit to you from mitigation, people still don't want to do it. There's lots of other settings. I think home insurance is actually one of the places where we know the least because the data is so poor on terms of actually financially how ruined are people when their house burns down. But we know a bit more in flood insurance because there's some flood claims data. And there's really good evidence there that, the mitigation that's forced by you have to do when you live in a floodplain area and you build a new house, people put zero value on that in terms of how much they're willing to pay for that house, despite it being very clear it lowers the amount of damages you face when your home floods. So there's just lots of evidence that even in these very clear-cut situations where this mitigation looks like it has a huge benefit to you in terms of not ruining your house, and people pay almost $0. So it's a hard uphill battle in a world where probabilities are small for people to be good at pricing that, thinking about those trade-offs in a sort of mathematically sort of actuarial way.
Yeah, and I think about it, You talk about where does it pencil out and how do we get consumers to do what we're after. So take the roof side of the equation. You got a 6-year-old roof, it is hard pressed for you to pencil that out and says you should rip it off and replace it because this would be better. At the point that you are replacing it, either because of a storm or it's aged out, the incremental cost of meeting that fortified standard is several $100s. It's not beyond, and it pencils out from a discount perspective very quickly. But you have to meet the moment where they're already going to take that action. Because saying, hey, you should go replace your roof for $17,000, it'll save you $350 next year, doesn't work in that space. And so we've got to find ways. To your point, and I spent way too many years recovering from my flood insurance excursions. Never trust the politicians. To that earlier panel, they will always meddle or just not do anything. But we've got to find ways, rather than trying to convince them to take this resilient action. I just don't see us succeeding. We've got to find a way to integrate it into other transactions that they are intending or likely to take, and reduce the friction in ways that it just becomes normal. Because I saw this over and over in flood. I've seen this play in the wildfire as well as high wind events. People just hope it won't happen. And trying to scare them with some risk map or risk quotient will fall apart. And so I do think we're relying on the economists, and particularly the behavioral economists and the marketing side of the equation, of how do we find things that are incremental costs with ways to pay for them. And I do think we've got to find some sidecar financing ways to help people pay for them so that it walks alongside, as opposed to you going, you know what, my house really is sick. I should go make a big investment in it. We just don't see very many people do that.
Well, particularly if the other option is like new countertops. Right, and when we're talking, I think that's certainly that's a conversation that many homeowners in California think about. Is their house poor? They may want to make an investment in their home, but which investment is and wildfire risk may be one priority, but it's not the only one.
Granite countertops or 5 feet around your house that won't burn.
Yeah.
I think they choose granite every single time. I just want crushed granite on the side of the house, but they want to put shiny granite in the kitchen.
I don't want to talk about California too much, but I will say one other thing that's, I think, a little different about the wildfire peril from the hurricane peril, for example, is those 5 feet of defensible space around my home. That may come at a real aesthetic cost to me as a homeowner. I may actually really have loved the, let's say juniper, a really flammable bush. I may have loved that juniper bush. This is probably prettier bushes that are less flammable, but let's say juniper. And so there's a real trade-off there that's harder to contend with. When you think about hurricane resilience, that I could have nails 6 inches apart or 12 inches apart, keeping my roof attached to my house. I don't care, right? So there's that margin in California that's a little harder, I think.
So, I think it's clear that there are kind of profound information problems playing through all of this. There's a question, this is something actually personally I've been going through with our own insurer, is looking at some of the data from Los Angeles and wondering if I'm with the right carrier for exactly the reasons that Rebecca has mentioned. There are also information problems about which mitigations are going to be effective given the context in which you live. There are questions about payoff. But as you think about trying to attack some of these information problems in the insurance space, where do you think the low-hanging fruit are that are going to actually create change in the world?
So one thing I think that's sort of important to think about of who's making the decisions here is, at least for people with mortgages, banks actually influence a lot of the decisions about insurance. So banks are going to check and force you to have homeowners insurance even if you want to drop it. And they're going to follow up and collect escrow payments from you and make sure you pay. But what's interesting is they don't actually do that for flood insurance usually. It's very common for people to live in floodplains, and when you buy your house, they'll make you buy the insurance, but usually the bank will turn a blind eye and not make you renew your insurance for flood, but they will for homeowners. And that's a choice by the bank. And what do we see? We see almost all homeowners keep their home insurance policy year on year, but many homeowners that live in high flood risk areas, they drop their flood policy. So mortgage is central to being able to become a homeowner and stay a homeowner. So, and the bank is very much financially in the middle of this home insurance transaction. So the more I think things are aligned or misaligned with the bank, drives a lot of the decision on the extensive margin of how homeowners make decisions about insurance. The bank is a much more financially sophisticated player here. They can do the math and they can impose decisions on the homeowner whether they like it or not. So I think they're an interesting player. There are pluses and minuses of having them more involved in these decisions, but they can force the hand.
I don't think there is any low-hanging fruit. I just don't. This problem's far too complex in that space. And so I look at it and go, we have to triangulate. And across each of the perils, it's some variation of three things. You actually need to create a common denominator, whether that's through codes, HOA rules, et cetera. You got to change and make it more common and raise the boat. The second piece is insurance companies need to price the risk, and if the risk goes down, there should be a price consideration there. That nudge is important. It's not going to fully fund the action that you took. The third piece is there's got to be a workforce to do it. And we're watching right now where there are people who are wanting to take the action to address their structure, whether it's a business or their home, and they can't actually get people to do the work. They put the money together. They put those elements in play. And so we've got to be addressing the capacity to do the work. Because if you got yourself all the way to the point to be willing to do it, and then it's just too hard, you throw up your hands and go, I don't know, just give me a roof. Whatever it is, I'm done having this conversation. Let's move on.
Do any of you, so today we've talked we have talked exclusively about homeowners insurance. But there's a large segment of our population that do not own their homes, whose houses also are destroyed in hurricanes or damaged in severe convective storms or burned down in wildfires. How should we be thinking about renters in the context of a healthy insurance market and recovery, importantly, recovery from disaster? We've seen there are lots of sort of principal agent problems that come up in the energy space and the energy efficiency space related to renters and landlords. Are those the same problems for catastrophic risk? Do we see something better happening for catastrophe? And are there things that we should be thinking about at the policy level to help renters recover after these catastrophes?
I think that's a really important point, that when you're a renter, you've decoupled the structure ownership from all of the misery of your life getting turned upside down from where you live and potentially all your contents either fully or partially destroyed. I mean, there's the principal agent issue, but there's also some aspect of by dividing the financial risk actually between the landlord and the renter that actually could be good for recovery. The person who has to figure out as the renter how to, find a new place to live, get new belongings, they don't have to worry about rebuilding their home. And the landlord, who's potentially more financially liquid on average than the typical renter, they actually don't have to deal with the fact that their place of residence just got destroyed at the same time that they have to navigate how to rebuild a home. So actually decoupling those risks would be there are a lot of reasons to think that's a good thing. Mm-hmm. And it highlights, again, that we don't know that much about whether the benefit of insurance is really about the financial cost of rebuilding your home, or is it more the benefit of having to pay for some alternative place to live, which the renter would face, having to repurchase all your contents, which a renter would have to face. Studying renters and landlords and homeowners collectively together would help be very elucidating on where is the big sort of, call it economic well-being loss. It's not all financial. It's also this like life turning upside down. And the more we could separate that between the landlord and the renter would sort of help diversify the risk, even without more intervention from other markets.
Yeah, I think in the rental space, there's plenty of product that's available, and the price point of it is not out of reach. It's just not front of mind in the choices they're making. When I was chief executive of National Flood, we count these by contents-only policies. It was never more than a couple percentage of the total book that was in that play. I think in some instances, folks go, hey, that's an extra $262 a year. I don't have the money to spend on it. The other side of the equation, they may have the $262 in this hypothetical contents-only policy that would cover $40,000 worth, would sure help them recover much more quickly if they needed to pick up and move. But the market isn't getting all the way to them to say, do you want this product? It's not the kind of thing, I'm not trying to pick on insurance agents, but if the product's only a couple $100, the commission on that is the kind of thing that goes, it's just not worth the lift on their side. We are seeing in the renters space more direct-to-consumer options in those elements, but you have to want the product and go hunting for it. Whereas if you have a mortgage, when you go to the closing table, someone's demanding you show proof of that just doesn't exist on the renter side.
I'll quickly plug some research coming to you soon, which is new work that we've done. My co-authors and I we're following individuals who were living in houses that suffered a total loss. This happens to be wildfires. So like across 100 major US wildfires, we're following these individuals who were living in the house at the time that it burned down for several years after in the IRS data and the census microdata. So we're able to see with all the appropriate privacy protections at a very granular level of detail what happens to people's financial lives after they suffer a total loss in terms of income, in terms of drawing down your tax-preferred retirement savings accounts, in terms of disruptions to your employer-employee relationship, in terms of whether you move to another county or another state. And we can see all those things differentially for homeowners and renters. So we'll have some answers for you, I think, on that point soon.
Well, I love a plug. Do you have any questions from the audience? We have a few minutes. And then the gentleman in the front, if we have.
Hi, Carly Fabian from Public Citizen. Really appreciated the comments about the importance of getting the grants and the contractor training to kickstart mitigation. And I'm wondering if you could talk a little bit about the funding for those grants. As additional states are thinking about starting these up, we're seeing that disappear from the bills, or states are sort of forgetting where that comes from. So I'm wondering if you could talk about whether additional states should be following Alabama's lead and asking the insurance companies to pitch in to help kickstart that.
Okay, a couple of pieces on that. There used to be a lot of federal money in mitigation. One might even says there still is a whole lot of money there. It's just not being spent, and I'll leave that to someone else to figure out what to do with. I think what Alabama has going for it, and it's true in Louisiana, it's true in the Carolinas, the money is exclusively coming inside the state. What I will say is different, though, is it's actually not the insurance companies chipping in. What Alabama did is work with their state legislature so that they're taking a part of the premium taxes as they flow through. And they did it in a year where things were going up, and they took a piece off, and they've been able to reserve that. And it is part of the premium taxes that is going into that in perpetual fashion. I think right now the fact that states were funding it themselves meant that it survived the political turbulence of those programs that exist today. I will also tell you that they are far more efficient. If Alabama had an infusion of $50 million in FEMA money, their program would just fall on itself because they'd have to fall follow a whole bunch of FEMA rules that are just going to slow them down. And so the state-based programs are really agile and quick in that space. I don't know what's going to happen with resilience dollars across the country, but if you have a state-based program, it's functioning.
Thank you. Ken Fielding with NASA and NOAA Geospatial and Data Visualization Technologies. We're seeing a kind of a breakdown of real transparent hazard intelligence data and risk information data, whereby we can sort of align data so that mitigation can occur, so that investors can have real data to make reasonable adjustments in premiums or where risks are. So what are the metrics or the analytics that you're looking at that can help make that alignment occur? And are you using any technology tools? Because in risk zones like mine, I'm from Louisiana, where insurance companies have left Louisiana. We're trying to mitigate that. So we're having a conversation with the insurance commissioner to do that. But the data still isn't always there for them to bring their case to the insurers and to reinsurers.
Yeah. To give you just a real quick piece on that, first and foremost, all of these companies are reliant on the data that comes from NOAA and NASA, and we need that flow of data to continue to flow. That's a public good, and we are all better off for it. I do think that there are all kinds of innovations happening in the modeling to understand risk. Some of that is proprietary, some of that is more broadly available. FEMA used to have a tool that would allow people to see their risk. I don't think that's up any longer. That's a longer conversation worth having about how we get it to the point by which consumers know what to do with it. That said, and this goes back to my experience with flood, simply telling someone they've got a flood risk just means they're going to tell you it's not true. And so just telling them about the risk doesn't change it if we don't help them actually change the outcome.
And I will build on that. I think, there's really interesting policy questions about how we as a society want to pay for risk modeling. For many perils, we've sort of gone with a model where we have proprietary models where there's a big profit incentive to potentially make a lot of money if you can build a better model that gets more widely adopted, or a model that gets more widely adopted. And there's another model, which is open science, transparent, university funded, and I obviously have my interest in that fight. Where I work, which of those worlds I work in. But they're setting aside, sort of personal interests. There's just a really interesting policy trade-off between, are we going to try and do this through private markets and have strong profit incentives to build really good models, or are we going to favor a world where we have more transparency but potentially less profit incentives?
I think we are close to time. One last question, if there is one from the audience. Okay, I'm going to give everybody just a chance to have a parting thought. Rebecca, I'd like to start with you. Like, if you could see one change in either the research space on insurance or actually change in the world in the next 5 to 10 years.
If I could just check outcomes, let's just get rid of wildfires.
Easy. Yeah.
I think, so I'm going to be a little bit of a nerdy academic. I think we need better universal access to data on exactly how people use their insurance policies, home insurance, renter's insurance, the landlord's dwelling policies, so that it's not just the insurance companies that really know. I mean, think about the incentives of the insurance companies in the state of the world where your house burns down. They make money if they don't pay you. That's at that moment, that's the trade-off. You've sunk the policy. They've already collected the revenue from that. Every dollar they don't pay you is dollars that they get to keep. And we have so little transparency into that issue that may be the big elephant in the room that no one's talking about. So I think just this data exists. The insurance companies share it between each other, and they won't give it out to anyone but each other. And I think that's just a huge policy failure.
Judd?
Okay, I will. Here, I'm an academic. It's my job to ask big, silly, really naive questions. So I'm going to ask a big, silly, really naive question that goes to the whole discussion about coverage gaps. Why do we have coverage A limits in homeowners insurance policies? That's actually a relatively recent phenomenon in the market. Not that long ago, guaranteed replacement cost coverage was the standard. There are a few reasons why we might. One reason might be that if insurers were on the hook to cover guaranteed replacement costs, that would be dramatically more expensive. One way of saying that is that if everyone had adequate coverage, insurance would cost a lot more than it does today. So is that just saying that we don't actually want a world where everyone has adequate coverage because it's too expensive? Is it another explanation is that if insurers are on the hook to pay for rebuilding no matter what, they're worried about all the moral hazard problems that are the exact opposite of what Rebecca was just talking about. Rebecca was talking about the moral hazard on the side of the insurance company to try and not pay you. The homeowner has every incentive to try and get their house rebuilt with the best marble countertops. And so maybe the coverage A limit is a way of managing that moral hazard problem. Is there a better way to do that that doesn't leave homeowners exposed to all this? Fundamentally, at the end of the day, we've taken the least informed party in the transaction and made them responsible for making sure that they know how much it would cost to rebuild their house and have adequate coverage. It just seems like maybe we could do it differently.
I'm going to say this. Edward Lloyd had a coffee house in London. It's where all this insurance stuff starts. Fundamentally, and I won't be quite as cynical in terms of what companies will or won't pay, if we want the price to go down, we actually have to shrink that risk. If the risk is going to keep growing, the cost of that is going to broaden. And so I think we've got to look at the fundamental baseline of what is there. Understand that the values of our homes are going up, and we're very proud of that the day we try to sell it. We want our equity out of our homes. And the other days, well, the cost of rebuilding inflation is played out. And so we've got to look at the finite cost of replacement in that space and address those pieces in terms of expectations as well as expected losses.
All right. Thank you all. Thank you to the panel for an excellent conversation. Thank you everyone for coming.